Hi, I'm Adam DeSanctis. Welcome to MBA Asks the Expert, a series where we discuss a timely and important issue with a mortgage industry leader. Today, I'm here with Proctor Loan Protector's Malgosia Stella, Senior Vice President of Compliance, for part 4 of our series on insurance tracking issues. Today, we're tackling the evolving regulatory environment around insurance. Malgosia, thank you for joining us today.
Yeah, thank you. Happy to be here.
Let's get started. There's a lot to talk about today. Compliance is a complex and nuanced topic, but it's so important in all facets of our industry. From your perspective, what do you consider to be the most significant regulatory change of 2025 impacting lender-placed insurance compliance?
So I think probably the most significant regulatory change of 2025 has to be the weakening of the CFPB. And this shift is dramatic because the CFPB has historically been a very active and powerful enforcer of federal consumer protection laws, which include RESPA, which of course governs the requirements around lender-placed insurance. And if we were having this conversation a year ago, the tone would be completely different because the CFPB was highly active, and now today its role and capacity have changed substantially. So there are a few reasons for that. And the first one was that we saw there's been a shift of priorities. With the new administration, the focus has been more on concentrating on fraud and tangible consumer harm, and not necessarily the technical violations. We've also seen exams being dramatically cut to about 50% of what they used to be. We've also seen a reduction in the regulatory burden. So back in May of 25, the CFPB withdrew 67 guidance documents that were previously provided to the industry to provide guidance on the interpretation of various consumer protection laws. Additionally, we've seen that the CFPB has been really hit hard with issues such as staffing. So back in January, it was announced that the CFPB plans to reduce its workforce by 90%, bringing it down from 1,700 to about 200. And while the initial legal challenges delayed this, the DC Court of Appeals overturned the block in August, and they're still pending rehearing petition. So layoffs haven't occurred yet. But if it's denied, the Bureau could proceed with its downsizing. And actually, not any of that could matter if the CFPB runs out of money, which according to the CFPB itself, they're about to run out of money at the end of 2025. So this, of course, adds to the uncertainty because, based on new Justice Department opinion, the CFPB is prohibited from withdrawing any additional funding from the Federal Reserve, which means that it's running on its own reserves right now, which again are projected to run out in early 2026. And of course, Congress could appropriate more funds, but it's unclear whether that would happen. And if that does happen, there's a real question on the Bureau's ability to maintain normal operations. So, bottom line is there's, less CFPB oversight, but, I think it lends a little bit of uncertainty to the industry.
Yeah, we agree with that. And that was a great breakdown of a lot has happened certainly at the CFPB over the last 11 months. But with the CFPB stepping back, how are states addressing this regulatory gap?
Sure. So in the absence of a strong CFPB, we see that states have really stepped up aggressively to fill in that regulatory gap. And we see states are increasing their enforcement actions. Many states have their own consumer protection laws, and we're seeing more and more investigations and lawsuits that are targeting mortgage servicing practices, debt collection, unfair lending. We see attorney general and state banking and insurance departments. They're using UDAP and unfair fee authorities to regulate mortgage servicers. We're also seeing states adopting and proposing regulations and new laws. So states like New York, California, Massachusetts, they're proposing adopting laws that mirror the federal UDAP standards, which will allow them, of course, to hold servicers accountable for those at the state level. We're seeing things also like, defining junk fees and imposing new disclosure requirements. So for instance, in New York, we saw a recent law that would limit the amount that lenders and servicers could require a borrower to maintain with respect to flood insurance, and also requires the servicer or lender to provide a new disclosure to the borrower for residents of New York. Additionally, we're seeing there's a lot more collaboration between the states. So states are forming multi-state coalitions to pursue cases that would traditionally be under federal jurisdiction. And these coalitions allow states to pool their resources and to maintain the pressure on those larger financial institutions despite the federal pullback. We also see that the Conference of State Bank Supervisors launched its One Company, One Exam initiative. Now, this was technically back in 2024, but it does provide it provides a platform now for states to continue to expand their collaboration because it provides a streamlined multi-state exam platform and information sharing abilities. So, especially for those lenders and servicers in 10 or more states, those would be the ones who would be targeted first. So in short, we see the CFPB hasn't eliminated oversight, but it's definitely weakened. However, states have certainly shifted and asserted themselves as the primary enforcers, which creates a more, of course, fragmented framework than we had when we had a strong CFPB.
Yeah, it's sort of like a busy spider web of regulatory compliance going in every direction, the federal level, the state level, and it can certainly be a lot. So how can servicers prepare effectively for audits in this evolving regulatory environment?
First, it's important to remember that the compliance obligations have not changed. So Regulation X, including the lender-placed insurance rules, remains fully in effect. That means that lenders and servicers should continue to adhere to strict notice requirements, refunds, and everything else that's required for lender placement in RESPA. Second, it's important to maintain a strong compliance management system, and that includes having clear written policies and procedures. We're seeing that auditors are really focusing on institutions maintaining a good documentation of their policies and procedures and looking at those and reviewing those on a regular basis so that they're updated when regulations change, including when there's new state regulations. Additionally, consistent executions of policies and procedures is very important. And we have noticed that regulators are looking between your servicing and your lending and making sure that those policies stay consistent throughout. Additionally, monitor your complaint trends because a lot of those complaints are going to the states and states are taking them very seriously. So looking at those complaints gives you an insight of what trends could be happening within your organization. Finally, watch out for state laws. As I mentioned before, with the CFPB exams being cut, states are really stepping up, and we're seeing a lot more state supervision and examinations in the last year than we've seen in the past, especially those in mortgage servicing and fintech. Expect more state level exams and licensing requirements, and that means navigating the patchwork of rules, and you have to be able to be prepared for that multi-state exam under the One Company, One Exam initiative that's being launched. The bottom line is you need to still stay disciplined on federal requirements. You need to strengthen your CMS. And now you also need to build capacity for state oversight.
Malgosia, this has been very beneficial to our viewers and obviously a very important topic going forward. And we'll see what happens with the CFPB in 2026. Thank you again for joining us today.
Yeah, thank you very much.